Hello gentlemen, welcome back to BUS 325 Investments. Today we're looking at chapter 3. This chapter talks about the securities markets. In this chapter we are going to specifically focus on issues that relate to securities, how securities are issued, the trading of securities, the US and other international securities markets, and we'll also look at some of the regulations in securities markets. So let's get on to it. The first learning outcome for today is how firms issue securities. So I want to take a look at how this process works. When we look at securities and how they are exchanged, we can see that there are two types of security issues that are exchanged in either the primary markets or secondary markets. So in the primary markets, shares that are issued for the first time are being sold. So these are represented by new issues of shares created by a company, and the issuer basically seeks to get some funding in exchange of foregoing a portion of their ownership in that company. So they receive the proceeds from that exchange, and the investors in exchange get some portion of the ownership. Now these stocks or new issues, or IPOs as they are usually called, initial public offerings, can be sold in two kinds. They could either be sold in a public offering, so in that case they would be registered with the Stock Exchange Commission, and the sale is made to the public, so anyone who wants to invest and buy that IPO would just apply and purchase it. The other kind is private offerings. So in the primary market, sometimes a company would decide that they want to issue shares, but they don't want to offer it to the public, so they just offer it to a small group of investors. This kind of issue is not registered with the SEC or the Stock Exchange Commission, and in this case the stocks are only sold for a limited number of investors with restrictions on resale. So these investors will not easily be able to exchange hands or exchange this ownership after they buy it for the first time. Now the secondary market is basically what you see when you look at stock exchanges. So when you look at the Saudi Stock Exchange, for example, or you look at the New York Stock Exchange or Nasdaq, you would see that current holders of specific shares, or for all the different companies that are listed on that stock exchange, will be able to sell their ownership or sell their stock to other investors. So at any time when I own, let's say, 10 stocks of Apple company, and I want to sell this ownership or this equity of mine, I would through a broker would offer these 10 shares for sale, and another investor would come and buy it from me. I get the money, he gets that ownership in exchange. Okay, so basically in those markets the existing owner sells their ownership to other parties, and in this case the issuing firm or the company or the underlying business that is this share represents an ownership in that business is not involved and does not receive any of the money or the proceeds of that sale. So if I sell my 10 Apple stocks, Apple company would not get any of that money. I will get all of it. Probably some of it will go to the broker as well, the broker that facilitated the exchange. As we have discussed in the previous slide, primary markets or primary issues can either be public offerings or private offerings. Now we'll look at the kinds of companies that would use different or one of these two offering types. So we first have a privately held firm. These are privately held companies that are owned by a relatively small number of shareholders. In your slide here, because it's based on the American markets, it is up to about 499 shareholders. But depending on the country, this regulation might be different. These privately held firms have fewer obligations to release financial statements and other information to the public. So this kind of freedom saves money and frees the firm from disclosing information that might be helpful to its competitors. And some firms also believe that eliminating requirements for quarterly earnings announcements gives them more flexibility to pursue long-term goals, away from any shareholder pressure. Now, when this kind of corporation or company wants to issue some shares, they would use what is called a private offering or a private placement, where the primary offering is sold directly to a small group of investors. Now keep in mind, this limitation or this financial freedom comes at a cost of the company's inability to raise large amounts of capital, because they're only limited by a specific number of shareholders, and these offerings are usually small in capitalization or in value. Now, when a privately owned firm decides that it wishes to raise capital from a wide range of investors, it may decide to go public. Okay, it does that through what is called an IPO, an initial public offering. Okay, which is basically the procedure of selling the stocks of the company to the public for the first time. Public offerings of both stocks and bonds typically are marketed by investment bankers, who in this role are called underwriters. More than one investment banker usually markets the securities, and a lead firm forms an underwriting syndicate of other investment bankers to share the responsibility for the stock issue. Investment bankers advise the firm regarding the terms on which it should attempt to sell the securities, so they help them with deciding the stock price, for example, and the timing of the issue and all of these details. A preliminary registration statement must be filed with the Securities and Exchange Commission, the SEC, describing the issue and the prospects of the company. When the statement is in final form and approved by the SEC, it is called the prospectus. Okay? The prospectus is basically the description of the firm and the security it is issuing. At this point, the price at which the securities will be offered to the public is announced to the public. In a typical underwriting arrangement, the investment bankers purchase the securities from the issuing company and then resell them to the public. Okay? In Saudi Arabia, usually, from what I know, the underwriter or the underwriting investment bank does not purchase the initial public offering, and instead makes an obligation to purchase all the remaining shares after the IPO is finished. Okay? Here in Saudi Arabia, or basically in Arabic, we call this procedure or this process iktitab. Okay? So when you purchase a company that is selling its stocks for the public for the first time. In figure 3.1, you could see the relationship between all the different parties that are involved in an IPO. So on the top you can see the issuing firm, which appoints a lead underwriter, and the lead underwriter also oversees all the different investment bankers that work underneath them, and these investment bankers would take the requests or the orders from the public or the private investors who have the intention of investing in that company, and report to the lead underwriter. On your Blackboard page, you will see that I will upload a these prospectus documents for Saudi Aramco's IPO, and on that document you would see that the lead underwriter for that IPO was Samba Capital. So it will be interesting for you to take a look at that document and see what a prospectus would normally look like. It might be too big because of how the sheer size of Saudi Aramco, but it will give you an idea of what that document that we just mentioned in the previous slide would look like. Another concept that is helpful for you to understand is what is called shelf registration. Shelf registration is an important innovation in the issuing of securities, and it was introduced in 1982 when the SEC approved Rule 415, which allows firms to register securities and gradually sell them to the public for 2 years following the initial registration. Because the securities are already registered, they can be sold on short notice with little additional paperwork. Moreover, they can be sold in small amounts without incurring substantial flotation costs. The securities are on the shelf, ready to be issued, which has given rise to the term shelf registration. Another way of IPOing is what is called a SPAC. SPAC is a special purpose acquisition company, and it is a company with no commercial operations that is formed strictly to raise capital through an initial public offering for the purpose of acquiring an existing company. It is also known as a blank check company. SPACs have been around for decades. However, in recent years they've gone mainstream, attracting big name underwriters and investors, and raising a record amount of IPO money in 2019. The last point in the first learning outcome that we want to cover here is we want to look at how the initial public offering actually works. So first, the first stage, or the first stages of the planning of the initial public offering, what would happen normally is that the issuer and the banker, or the lead investment bank, the underwriter, they put on what is called a roadshow, where they basically try to market the issue and gauge people's interest. This is done, of course, in the United States. Here in Saudi Arabia, for example, that is unheard of. I've never seen any roadshows that are carried out by the companies or the banks. They do advertise their issues, however, in newspapers and social media and things like that, and the purpose is the same. So basically they want to carry out what is called a book building. Book building is where the company or the investment bank and the issuing company try to get the investors to communicate their interest in purchasing the shares of the IPO. Okay, this helped them decide on the timing and the price for that IPO. Okay, and then what happens is normally the issuing company in IPOs usually would what they would do is that they were underprice the issue. This basically helps them market the issue, so they would value the issue or the IPO at a slightly lower price than the actual value or the fair value of that share that they are going to issue, and this tremendously helps market the security to be sold for the investors. Okay, and this causes the phenomena that is called the winner's curse, where normally what would happen in the post initial sale is that the stock price right after it is traded on the first day would rise in value tremendously, and this is what makes the IPOs attractive. If you remember back in 2005, 2006 and 7, right before the global financial crisis, IPOs or big book building was very famous, very common here in Saudi Arabia. Many companies were issuing their stocks for the first time, and a lot of people were participating in these IPOs. كانت طفرة اكتتابات في السعودية في هذيك الفترة. Okay, many people actually invested in those without even knowing much about the companies that were issuing those stocks, just because they know that it's not uncommon for these IPOs to rise in price tremendously on the first day or the first few days of being actually traded on this stock exchange. Okay. Now the pricing of IPOs is not really trivial, and not all IPOs turn out to be underpriced. So some do poorly after the issue. For example, 6 months after its IPO, Groupon shares were selling for about half the $20 offer price, and 2 weeks after its IPO, Facebook shares were down around 25%. Okay, other IPOs cannot even be fully sold to the market, so the underwriters are left with unmarketable securities and are forced to sell them at a loss on the secondary market. Therefore, the investment banker bears the price risk of any underwritten issues. All right. In figure 3.2 on your textbook, you can see the average first day returns for European IPOs. This reflects what we've been talking about when we discuss underpricing. Underpricing or IPO underpricing, anomaly as it's referred to in the financial literature, is referring to the estimated percentage of difference between the price at which the shares subsequently traded in the market and the initial or the price at which the IPO shares were sold to the investors, or the offer price of the issue, and at which the offering was introduced. Okay, underpricing is suggesting that firms which go public leave considerable amounts of money on the table. The amount of money left on the table is defined as the difference between the closing price on the first day and the offer price, multiplied of course by the number of shares that were sold. In the words of J. Ritter, this is the first day profit received by investors who were allocated shares at the offer price, and it represents a wealth transfer from the shareholders of the issuing firm to these investors that invested in the IPO. So underpricing is a loss, a cost for the issuers that they want to minimize, and of course a profit for the first investors that purchase and acquire the IPO shares. Now this figure shows the average first day returns for non-European IPOs, and it is worth noting that this phenomenon is usually called underpricing because it describes the additional amount of money which could have been raised by the issuer if the offer price had been set at an appropriate level, or basically a higher level. So this name represents the issuer's perspective on the price of the issue. Now the second learning outcome for today is looking at how securities are traded. In order to understand how securities are traded, we first look at the financial markets in which these securities are normally traded. Okay. Financial markets develop to meet the needs of particular traders, and consider what would happen if organized markets did not exist in the first place. So any household or any person wishing to invest in some type of financial asset would have to find others wishing to sell. So soon venues where interested traders could meet would become popular. Eventually, financial markets would emerge from these meeting places. So consider that a Manhattan curb, for example, on Wall Street became synonymous with the financial world. So if you keep hearing the term Wall Street in the United States, is one of the places where traders used to meet, still to this day, but this is part of how it all began. So a market in general is any place where buyers and sellers get to meet each other and exchange products and services, right? So if you take that understanding and draw that to the financial markets, this is basically where any forum or any place or any platform that facilitates this kind of meeting between investors and fund seekers, if you want to say. Alright. So the overall purpose, of course, of this is to facilitate low costs in the investments and bring together the buyers and sellers. Right. This subsequently provides adequate liquidity by minimizing time and cost to trade and promoting price continuity. Okay. So basically, this is the whole point of the existing of financial markets. Financial markets also help reduce information costs associated with investing. So the information would be available to investors and to equity seekers at a much lower cost because of how the financial markets facilitate the trading process between the investors and the funding seekers. Talking about exchange markets, we can differentiate four main types of these markets. We can categorize them based on the different elements or characterizations and level of activity of these markets. So we first begin with the direct search markets. A direct search market is the least organized market. In these type of markets, the buyers and the sellers must seek each other out directly. So there's no middleman. An example of a transaction in such a market is the sale of a used furniture piece or a TV or a cell phone or things like that on a Craigslist, for example, or on eBay. These markets are characterized by sporadic participation and low-priced and non-standard goods. And it would not pay for most people on firms to specialize in such markets. The second type of markets is the brokered market. This is the kind of a next level of organization, you might say. Um, in these markets, trading in a good is active, and the brokers find it profitable to offer search services to the buyers and sellers. A great example of this is the real estate market, where economies of scale in searches for available homes and for prospective buyers make it worthwhile for participants to pay brokers to conduct the search for them. Brokers in particular markets develop specialized knowledge on the valuing assets traded in this type of markets. An important brokered investment market is the primary market we just mentioned earlier, where new issues of securities are offered to the public. And in the primary market, investment bankers who market a firm's securities to the public act as the brokers, and they seek investors to purchase the securities directly from the issuing corporation. Third type is the dealer markets. We can define these as the markets in which traders specializing in particular assets buy and sell for their own accounts. So the dealers here specialize in various assets, purchase these assets for their own accounts, and later sell them for a profit from their inventory. And the spreads in this case between the dealer's buy or the bid price and the sell or the ask price are a source of profit for the dealer. These type of markets save the traders on search costs, because the market participants can easily look up the prices at which they can buy from or sell to dealers. A fair amount of market activity is required before dealing in a market is an attractive source of income. So most bonds trade in over-the-counter dealer markets. The fourth and last type of markets is the what is called the auction markets. Okay, this one is the most integrated market. In this type of markets, all traders converge at one place, either physically or electronically, to buy or sell an asset. The New York Stock Exchange is a good example of this. An advantage of an auction market over a dealer's market is that one need not to search across dealers to find the best price for a good. If all participants converge and get together, they can arrive at mutually agreeable prices and save the bid and ask spread. So we can basically define these as a market where all traders meet at one place to buy or sell an asset. Now, before we can consider actively participating in auction markets, it is worth understanding the types of orders that are involved in these kind of trades. So we have two main types of orders. We have market orders and price contingent orders. So for the market orders, the buy or sell orders that are to be executed immediately at current market prices. For example, if you as an investor might call the broker and ask for the market price for Apple stock, the broker might report back that the best bid price is currently $115 and the best ask price is 115 maybe and 5 cents, meaning that the investor would need to pay 115 and 5 cents to purchase a share, and could receive $115 a share if she wishes to sell some or if you wish to sell some of your stocks. The bid and ask spread in this case is 5 cents. So in order to buy a 100 shares at markets would result in the purchase at 115 and 5 cents and an order to sell at market would be executed at 115. Okay. So the bid price is the price at which a dealer or other trader is willing to purchase a security, and the ask price is the price at which a dealer or other trader will sell a security, and the bid and ask price, or the bid and ask spread, is the difference between the bid and ask prices. Now the other type of orders is the price contingent orders, and the investors in this case may place orders specifying prices at which they are willing to buy or sell a security. A limit buy order, for example, for Intel may instruct the broker to buy some number of shares if and when they may be obtained at or below a stipulated price. Conversely, a limit sell instructs the broker to sell if and when the stock price rises above a specified limit. Okay. So even when you as a retail investor, if you use a brokerage account, for example, you would notice these differences. So every time you go to execute an order, you will be given the option to either execute your orders based on market prices or use limit buys or sells. One more concept to also understand is the stop orders. Okay, stop orders are similar to limit orders in that the trade is not to be executed unless the stock hits a price limit. For stop loss orders, for example, the stock is to be sold if its price falls below a stipulated level. And of course, as the name suggests, the order lets the stock be sold to stop further losses from accumulating. And similarly, stop buy orders specify that a stock should be bought when its price rises above a specific limit. These trades often accompany short sales, so sales of securities you don't own but have borrowed from your broker, and are used to limit potential losses from the short position. So it is definitely important for you to understand these concepts and to understand the different types of orders that you can actually execute through your brokerage account when you go and try to invest in or participate in the stock markets. Also, to further understand how securities are traded, it is also worth learning how the trading mechanisms work. So, if an investor wishes to buy or sell shares, they will start by placing an order with a brokerage firm, and the broker will charge a commission for arranging the trade on the client's behalf. Brokers have several avenues to then go ahead and execute that trade and find the buyer or seller and arrange for the shares to be actually exchanged. So generally speaking, there are three trading systems employed in the United States. We have over-the-counter dealer markets, electronic communication networks, and specialist markets. The best known markets such as the Nasdaq or the New York Stock Exchange actually use a variety of trading procedures. So before delving into these markets, it is useful to understand the basic operation of each type of trading system. The first trading system or trading mechanism we want to look at is what occurs in dealer markets. In dealer markets, usually are involved in over-the-counter markets, or a considered an over-the-counter market, where the uninformal network of brokers and dealers who negotiates sales of securities. We want to look at the Nasdaq. It was originally organized as a price quotation system rather than a trading system. So while the brokers could survey bid and ask prices across the network of dealers in the search for the best trading opportunity, actual trades required direct negotiation between the investor's broker and the dealer in the security, usually over the phone back in the day. However, as we will see, Nasdaq has progressed far beyond a pure price quotation system. So while the dealers still post bid and ask prices over the network, what is now called the Nasdaq stock market allows for electronic execution of trades at the quoted prices without the need for direct negotiation. And the vast majority of trades are executed electronically. The other type of trading mechanism is the electronic communication networks, or the use of electronic communication networks, ECNs. These allow participants to post market and limit orders over computer networks, and the limit order book is available to all participants. So we can define these as computer networks that allow direct trading without the need for market makers. And the third and last trading mechanism is what is carried out in specialist markets. These require specialist systems which have been largely replaced by electronic communication networks, but as recently as a decade ago they were still a dominant form of market organization for trading in stocks. And in these systems, exchanges such as the New York Stock Exchange assign responsibility for managing the trading in each security to a specialist. Brokers wishing to buy or sell shares for their clients direct the trade to the specialists post on the floor of the exchange. While each security is assigned to only one specialist, each specialist firm makes a market in many securities. The specialist then maintains the limit order book of all outstanding unexecuted limit orders, and when the orders can be executed at market prices, the specialist executes or crosses the trade. The highest outstanding bid price and the lowest outstanding ask price win the trade. So a specialist is a trader who makes a market in the shares of one or more firms, and who maintains a fair and orderly market by dealing personally in the market. So if you ever seen one of these old videos for the New York Stock Exchange, you would see those kind of specialists on the trading floor shouting and yelling across the room. So this is what that is about. Now, talking about the two main stock exchanges that are very well known globally, the Nasdaq, when it was first established, was primarily an over-the-counter dealer market, and the New York Stock Exchange was a specialist market. But today both are primarily electronic markets, so these changes were driven by an interaction of new technologies and new regulations. And new regulations allowed brokers to compete for businesses, and broke the hold that dealers once had on information about best available bid and ask prices. This forced integration of markets and allowed securities to trade in ever smaller price increments. These are called the tick sizes. and the technology development made it possible for traders to rapidly compare prices across markets and direct their trades to the markets which or with the best prices. And this resulting competition drove down the cost of trade execution to a tiny fraction of its value just a few decades ago. And you can see this yourself nowadays. In the few most recent years, we actually have brokers or electronic brokers that they don't even charge any commission for an execution of trade aside from the bid and ask spreads. And they call these commission-free brokerages. This makes it interesting to look at the timeline of market changes and how these markets have evolved over the years. You could read this about this in your textbook and see the huge difference between the markets back in the 60s and 70s and what we actually have in today's markets. As an equity market investor, it is also worth looking at the US markets. So beginning with the Nasdaq stock market lists around 3,000 firms. It has steadily introduced ever more sophisticated trading platforms, which today handle the great majority of its trades. The current version, called the Nasdaq Market Center, consolidates Nasdaq's previous electronic markets into one integrated system. Nasdaq merged in 2008 with OMX, which is a Swedish-Finnish company that controls 7 Nordic and Baltic stock exchanges. This formed the Nasdaq OMX group. In addition to maintaining the Nasdaq stock market, it also maintains several stock markets in Europe, as well as an options and futures exchange in the United States. Nasdaq has 3 levels of subscribers. The highest level 3 subscribers are registered market makers. These are firms that make a market in securities, maintain inventories of securities, and post bid and ask prices at which they are willing to buy or sell shares. Level 3 subscribers can enter and change bid and ask quotes continually and have the fastest execution of trades. They profit from the spread between bid and ask prices. Level 2 subscribers receive all bid and ask quotes but cannot enter their own quotes. They can see which market makers are offering the best prices. These subscribers tend to be brokerage firms that execute trades for clients but do not actively deal in stocks for their own accounts. And level 1 subscribers receive only inside quotes, i.e. the best bid and ask prices, but do not see how many shares are being offered. These subscribers tend to be investors who are not actively buying or selling, but want information on current prices. The New York Stock Exchange, on the other hand, is the largest US stock exchange. Back in 2006, the New York Stock Exchange merged with Archipelago Exchange to form a publicly held company called the New York Stock Exchange Group. And then in 2007, it merged with the European exchange Euronext to form New York Stock Exchange Euronext. The firm acquired the American Stock Exchange in 2008, which has since been renamed NYSE Amex, and focuses on small firms. more than 1 billion shares trade daily on the New York Stock Exchange, and New York Stock Exchange ARCA is the firm's electronic communications network, and this is where the bulk of exchange-traded funds trade, which we call them ETFs. The New York Stock Exchange was long committed to its specialist trading system, which relied heavily on human participation in trade execution. It began its transition to electronic trading for smaller trades in 1976 with the introduction of its DOT, designated order turnaround, and later super DOT systems, which could route orders directly to the specialist. In 2000, the exchange launched Direct Plus, which could automatically cross smaller trades up to 1,099 shares without any human intervention. And in 2004, it began eliminating the size restriction on Direct Plus. The change of emphasis dramatically accelerated in 2006 with the introduction of the New York Stock Exchange hybrid market, which allowed brokers to send orders either for immediate electronic execution or to the specialist, who could seek price improvement from another trade. The hybrid system allowed the New York Stock Exchange to qualify as a fast market for the purpose of regulation NMS, but still offer the advantages of human intervention for more complicated trades. In contrast, the New York Stock Exchange's ARCA marketplace is fully electronic. Which takes us to the ECNs, or the electronic communication networks, which over time have seen a bigger market share. So they the fully automated markets have gained a lot of popularity over time and have gained a larger market share at the exchange of less automated ones. In particular, the New York Stock Exchange. So some of the biggest ECNs today are Direct Edge, BATS, and New York Stock Exchange ARCA. Brokers that have an affiliation with an ECN have computer access and can enter orders in the limit order book. And as orders are received, the system determines whether there is a matching order, and if so, the trade is immediately crossed. Now, originally, ECNs were open only to other traders using the same system, but following the implementation of Reg NMS, ECNs began listing limit orders on other networks. So the traders could use their computer systems to sit through the limit order books of many ECNs and instantaneously route orders to the market with the best prices. So those cross-market links have become the impetus for one of the more popular strategies of so-called high-frequency traders or daily traders, or what they call them today, active day traders. Okay, these seek to profit from even small transitionary or discrepancies in the prices across markets. Spread is obviously of the essence here. So ECNs compete in terms of the speed they can offer. Latency which refers to the limits it takes to accept, process, and deliver a trading order. BATS, for example, advertises in 2012 latency times of around 200 microseconds, i.e. 0.0002 of a second. Okay, and in recent research, these are kind of grouped as an outlying category from investment. So some of the research excludes these groups of traders from the broader name of investors. So you could say these are speculative investors who bid on the smaller changes in prices of the stock they're trading in over the course of the trading period. The recent changes or advancements in technology have given us some new trading strategies. These include algorithmic trading, which is the use of computer programs to make rapid trading decisions. And these, of course, are involved in what is called the high frequency trading, or the day traders we just mentioned earlier. So they use computer programs to make very rapid trading decisions in order to compete for a very small profit. It also gave us the what is called dark pools. These dark pools include large traders who seek anonymity, so they basically don't want to be known because they fear that if others see them executing a buy or a sell program, their intentions will become public and prices will move against them. So the very large trades, which are called blocks, usually defined as a trade of more than 10,000 shares, have traditionally been bought to block houses, brokerage firms specializing in matching block buyers and sellers. Block trading today has been displaced to a great extent by what is called dark pools. The dark pools trading systems in which participants can buy or sell large blocks of securities without showing their hand. So not only are buyers and sellers in dark pools hidden from the public, but even trades may not be reported, or if they are reported, they may be lumped with other trades to obscure the information about particular participants. Now let's look at how the stock markets are looking today under the globalization of stock markets. Now all major stock markets today are effectively electronic. So the trades, the buys and the sells are executed electronically. The quotations for the prices and the bid and ask prices are also accessed promptly electronically. Securities markets have come under increasing pressure in the recent years to make international alliances or mergers. Much of this pressure is due to the impact of electronic trading. To a growing extent, traders view stock markets as networks that link them to other traders, and there are increasingly fewer limits on the securities around the world that they can trade. Against this background, it becomes more important for exchanges to provide the cheapest and most efficient mechanism by which trades can be executed and cleared. This argues for global alliances that can facilitate the nuts and bolts of cross-border trading and can benefit from economies of scale. Exchanges feel that they eventually need to offer 24-hour global markets. And finally, companies want to be able to go beyond national borders when they wish to raise capital. And we certainly see this today. So anyone around the world can open a brokerage account through their smartphone and invest in almost any security listed on any global exchange. I certainly do this personally. I through my smartphone I can access my brokerage account and buy, let's say, a stock in a Vanguard mutual fund, or a Microsoft stock, or any other company listed maybe in the United States or in Canada or so on, as long as my brokerage firm grants me access to that security, I can trade it, I can invest in it. And this takes us to the costs of actually trading. So in the trading game, you have explicit costs that are obvious, and you have some implicit costs that are less obvious. So the obvious costs are, of course, the commissions, which are the fees that are paid to the broker for making a transaction. So every time you execute an order through your broker, you pay a specific commission, of course, depending on the pricing system that the broker follows. So some brokers, for example, charge a set fee for each transaction, and some brokers set the fee to be in proportion to the size of your order. Okay. The less obvious costs of trading include the spreads, which are basically the difference between the bid and ask prices. So when you look at the bid being the price that the dealer will buy from you, and the ask, which is the price at which the dealer will sell to you, the spread here is the difference between those two quotations. And usually the cost of trading is a combination of both. So you have the commission and you have your spread. In recent years, and maybe in the last 5 years or so, more and more brokers are offering commission-free trading. So you basically got rid of the commission, and now they gain their income, or they charge you only by the spread charges, or the differences between the bid and ask prices. Another recent development in security markets is buying on margin. So it is worth looking at that and trying to understand what that actually means. So when purchasing securities, the investors have easy access to a source of debt financing called the broker's call loans, and the act of taking advantage of broker's call loans is called buying on margin. So purchasing stocks on margin means the investor borrows part of the purchase price of the stock from a broker. The margin in the account is the portion of the purchase price contributed by the investor, and the remainder is borrowed from the broker. The brokers in turn borrow money from banks at the call money rate to finance these purchases. They then charge their clients that rate plus a service charge for the loan. All securities purchased on margin must be maintained with the brokerage firm and street name, for the securities are collateral for the loan. The Board of Governors of the Federal Reserve System limits the extent to which stock purchases can be financed using margin loans. The current initial margin requirement is 50%, meaning that at least 50% of the purchase price must be paid for in cash, with the rest borrowed. Now if you look at the example in your textbook, in example 3.1, you can see an example of what buying on margin might look like and how it's calculated. And it's also worth noting that the initial margin requirement, if it was 50%, for example, in this case, then you can also calculate the maximum percentage of the amount the investor can borrow by basically deducting the IMR or the initial margin requirement from 1. Now if the stock value falls below a specific a certain amount, owner's equity would become negative, meaning the value of the stock is no longer sufficient collateral to cover the loan from the broker. So to guard against this possibility, the broker sets a maintenance margin. If the percentage margin falls below the maintenance level, the broker will issue a margin call. So basically requiring the investor to add new cash or securities to the margin account. And if the investor does not act, the broker may sell securities from the account to pay off enough of the loan to restore the percentage margin to an acceptable level. Now you might ask yourself why investors might be buying securities on margin. Of course they do so when they wish to invest an amount greater than their own money allows. Thus they can achieve greater upside potential, but they also expose themselves to greater downside risk. Here we have 3 key formulas that will be needed for margin investing, and we will use those when we come to do some exercises and practice. But it's worth looking at them here briefly. So the when does the margin call occurs? It occurs when the maintenance margin requirement is met. So if the equity divided by the market value, how do we figure out the MMR or the maintenance margin requirement? Is by basically dividing the equity by the market value. Now to calculate the market value, we use the formula market value minus borrowed amount divided by the market value, which gives us the MMR. And of course usually the MMR, the maintenance margin requirement, is given, so we solve this formula for the market value. And finally the margin call will occur when the market value, which is calculated by the borrowed amount divided by 1 minus the maintenance margin requirement. Here's a quick example to see how that works. If we assume that we are buying on margin a company or an investment with a stock price of $70, and the initial margin in this case is 50%, and the maintenance margin is 40%, and we're buying 1,000 shares. So the initial position in this case would be 70,000, being the number of shares, of course, multiplied by the price of each share. And because we are in an initial margin of 50%, that means we're gonna invest 50% of our own money, and the other 50% will be borrowed. So in this case $35,000 will be invested, and the other $35,000 would be borrowed. So assuming the stock price falls to $60 per share, we see that we can figure out how much is our margin in that case by the formula we just looked at in the previous slide. So look at the current market value for the investment, which is in this case 60,000, minus the borrowed amount, which is 35,000, gives us the 25,000, and we divide that by the market value. Okay, the 60,000 again. This gives us the current margin, which is 41.67%. Now if you want to also calculate how far the price can fall before a margin call would occur, you use the last formula in the 2 previous slides. which was basically the borrowed amount, in this case 35,000, divided by 1 minus the margin, so 1 minus 40%, and this will give us the market value of 58,333. That means the price per share can fall to $58.33, and if that occurs, we will as a margin investors, we will receive a margin call. From our previous calculation, you can see that we divide that amount by the number of shares, which is in this case 1,000, and that would give us the stock price per share of 58.33, and that is the amount that the stock can fall to before we receive a margin call. Okay, because in this case the margin percentage, since we know it's going to be 40%, that means our equity in this case will be exactly valued at 23,333. So when we put the formula, the equity amount divided by the borrowed amount, or by the current value of the stock price, we set that equal 40%. We solve for the equity value. We see that it's 23,333. Now, to restore that to the initial margin requirement of the 50% required by the government, you see that you're gonna need to restore your equity value to half of 58,333. So we basically multiply that figure by 1/2, or by 0.5, which will give us 29,167. And since our equity is currently valued at 23,333, that means we're gonna need to invest more, or contribute more money, which is the difference between the 29,000 and the 23,000. Now this slide here is designed to show you how risky it is to buy stocks on margin. So again, referring back to our example of buying a stock at $70 per share, if we assume that we are borrowing at 7% annual percentage return, the as an interest to our borrowing on margin, and use the full amount of the margin allowed, which is 50% of the stock price borrowed, so $35 per share borrowed, we can see that we have two scenarios here. Scenario A, where the stock price might see an increase, and scenario B, the stock price might fall. And on the top line of the table you see in front of you, you see the percentage gained or the percentage lost if you assume that you bought the shares with no margin. Now notice the difference if you have actually bought the shares on margin. In the case of the stock seeing an increase or a capital gain, instead of gaining only 11.59%, your gain would actually be magnified to 16.17%, whereas the opposite occurs when the stock actually drops in value. So when the stock drops in value to 68%, that means it lost $2 in value or in price. In the case of no margin, the unrealized loss here will be minus 11.59%, whereas in the margin case the loss will be minus 30.17%. So you can see how huge the impact of margin in here. So the leverage factor in those two cases is that in the case of the capital gain or the increase in price, the leverage value is, or the leverage factor is 1.4 times the return, where in the loss case or the reduction in price, the leverage factor increases tremendously to 2.62, just a little less than doubles. Okay. Now, why is that happen? This happens because in the case of the increase in price, you as an investor will get that gain, and you'll only owe the 7% interest on the borrowed amount. Whereas if the stock actually loses some value or the stock price drops, you are gonna be liable for the complete losses and the interest on the borrowed amount on top of that. So you can see that how margin can make your investments a lot more riskier. It can get you some extra gains in the case of an increase in price, but it exposes you as an investor to a tremendous amount of downside in case your investment drops in value. Here you see another illustration of how big the effect of buying stocks on margin is on your returns as an investor. So if we assume that your investments have seen a 30% increase during a year, the end of year value of your shares would be 26,000. You're gonna repay the principal and the interest, so 10,900. In this case, the investor's rate of return is going to be 51%. If the stock remained constant, so the stock price did not change for a complete year, you're still going to repay the principal and the interest, which actually going to make your rate of return, instead of 0% if you bought the stocks from your own money, it's gonna make it -9%, because you're gonna lose the principal and the interest that you're gonna pay back to the broker. And worst case scenario, if the investment goes down by 30% in value, the end of year value of the shares is gonna be 14,000, and again you're still gonna pay the same exact amount of 10,900, which is the principal of your borrowed amount plus the interest. And in this case, your rate of return for the year is going to be -69%. Now we'll talk a little bit about short selling, if you ever heard of the term before, which basically stands for selling shares that are not owned by the investor himself, but actually borrowed through a broker and later purchased to replace that loan. The way this works is that the investor would borrow a stock from a broker, okay, and in this case he will be obligated to post a margin, and then the broker sells that stock and deposits the proceeds and the margin in a margin account. Okay, you as an investor in this case are not allowed to withdraw the proceeds until you cover. Okay, and covering or closing out the position is basically when you buy the stock. So the broker returns the title to you from which it was actually borrowed. So when you compare short sales to what happens normally in the stock market, normally the investor would first buy a stock and later sell it, but with short sales the order is reversed. So first the investor would sell the share and then buy the share. So in both cases you begin and end with no shares. But the short sale actually allows the investor to profit from a decline in a securities price. So an investor borrows a share of stock from a broker and sells it. Later, the short seller must purchase a share of the same stock in order to replace the share that was borrowed, and this is called covering the short position. Okay, so the only way the short seller is going to benefit in this case is that if he sells the share, so borrows the share and sells it when the price is higher, and in the future when he needs to cover the price, or the stock price is reduced by that time, and this is the scenario where the short seller is going to benefit. And on the other hand, we have the long positions. So long positions buy first and sell later, which is the normal scenario that we talked about. And in this scenario, the investor is actually bullish. That means he's expecting the markets, or expecting a bull market, or expecting the markets to rise, at least for that specific stock that he purchased. Whereas the short position is called bearish, or he is expecting a bear market where the markets actually drop, or at least for that specific stock that he sold first and is obligated to buy later. And the round trip is basically a purchase and a sale of the same security is called a round trip. That means opening a position and then closing that position. Finally, for short sales, the required initial margin is usually 50%, so just like buying on margin, but it can get more for low priced stocks, especially penny stocks, stocks that are really low in value. And the exchange rules require that proceeds from a short sale must be kept on account with the broker. The short seller cannot invest these funds to generate income, although large or institutional investors typically will receive some income from the proceeds of a short sale being held with the broker. Short sellers also are required to post margin, so cash or collateral, with the broker to cover losses should the stock price rise during the short sale. Let's look at an example. Let's assume you sell 100 short shares of stock at $60 per share. Now 6,000 must be pledged to the broker, being the $60 multiplied by the number of shares. You must also pledge 50% margin, so you put up 3,000 and now you have 9,000 in the margin accounts. In this scenario, the short sale equity equals the total margin account minus the market value. Now the maintenance margin for the short sale of stock with a price greater than 16.75 is 30% market value. So 30% multiplied by the market value, which is a 6,000, that will give us 1,800. And in this case, that means you have 1,200 excess margin. This, of course, being the difference between the 3,000 and the 1,800, the maintenance margin. Now, what price for margin call? We'll see this in the following slide. So when we know that equity equals 30% of the market value, and we also know that equity should equal the total margin account minus market value, and that will give us the formula that we're going to need to calculate the price for a margin call. So it'll give us the from the two previous formulas, we can derive that market value equals total margin of the account divided by 1 plus minimum margin requirement. That means the market value is going to equal 9,000 divided by 1 plus the 30%. That gives us 6,923. So price for a margin call is 6,293 in total. Of course, we divide that by the number of shares to get the price per share, which is 69.23 cents. And if that occurs, we can find out that the equity will equal 9,000 minus the 6,923 that we just calculated. That will give us $2,077 as a value of the equity, or the contribution, the value of the contribution provided by the investor himself. Now the equity as a percentage of the market value, we can calculate that by dividing the 2,077 by the current stock price, which is the 6,923, which gives us the MMR of 30%. Now to restore the 50% initial margin requirement, we can calculate it by dividing the 6,923 by 2 and subtracting the 2,077 that we supposedly already contributed. And the difference between half of the stock value or stock price in the market minus the amount we already contributed, that will give us 1,384.50 cents. So that means the investor in this case is going to need to contribute $1,384.50 more into the account. Now, quickly brushing on the regulations of securities markets. The securities markets, or the trading activity in securities markets in the United States, is regulated by lots of different laws and regulations. The major governing legislation includes the Securities Act of 1933 and the Securities Exchange Act of 1934. The 1933 Act requires full disclosure of relevant information relating to the issue of a new security, so for an IPO. This is the act that requires registration of new securities and issuance of prospectus that detail the financial prospectus of the firm. The 1934 Act established the Securities and Exchange Commission to administer the provisions of the 1933 Act. It also extended the disclosure principle of the 1933 Act by requiring periodic disclosure of relevant financial information by firms with already issued securities on secondary exchanges. Now, aside from government laws and regulations, we have more regulations, including self-regulation, which is the most important overseer in this regard is the Financial Industry Regulatory Authority, FINRA, which is the largest non-governmental regulator of all securities firms in the United States. We also have the Sarbanes-Oxley Act, and we have the insider trading regulations that was established by the SEC. So it is I'm not really worried too much about this section, but it is definitely worth looking into and reading from your textbook to get an idea of how the stock market is generally regulated in the United States. And in the end, thank you, gentlemen, for listening to this lecture. I will be more than happy now to answer any questions that you guys might have. So, thank you.